Good afternoon, ladies and gentlemen, and welcome to the SmartSpace Software PLC final results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all of the questions submitted today and publish responses where it is appropriate to do so. These will be available via your Investor Meet company dashboard, and we will notify you by email when these are ready for your review. Before we begin, I would like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. I'd now like to hand you over to CEO Frank Beechnor and CFO Christian Shaw. Good afternoon.
Good morning, everybody, or good afternoon. I'm Frank Beechner, CEO. Thanks very much for joining us this morning for our year-end results to the end of January 2022. And this is Chris.
Morning, everybody. Afternoon. I'm Chris Shaw. I'm CFO of the business. Just going straight into the financial highlights for the year. The total group revenues for the year were up 11% on the prior year to 5.14 million. Included in that is quite a large increase in the recurring revenues, which increased by 43% to 3.42 million. And that's primarily driven by the swipedon and Space Connect businesses. The annual recurring revenue, which is really a snapshot of our recurring revenue at any particular point in time, was up 64% year on year to 4.94 million. And our gross margin from the continuing operations stayed constant at around about 71%. We had a similar mix of overall revenues in the year as to what we had in the previous year, and that's why it stayed constant. And as we move into next year, we also expect that to stay constant around 70%, as we expect both the recurring and the non-recurring revenues to grow in the next year. The adjusted EBITDA loss for the year was slightly more than what we had in the previous year. It was 2.49 million, and that really reflects the fact that we've got our Space Connect business to a level where we think that it's sustainable to grow. It had a very small team at the beginning of the year, and at the end of the year, it had a full team, which we think is suitable for the coming periods. The cash balance at the end of the period was 2.76 million. And as we move on to the 30th of April, you see that the cash balance was about 2.3 million, just under 2.3 million at the 30th of April. Our cash is particularly lumpy at the beginning of the year. We have some big items come out, and that's why it's decreased a reasonable amount in the first quarter. But as we move into the next quarters, we don't expect it to be at the same rate for the rest of the year. You can see here from these charts the growth in our recurring revenue. On the left-hand chart, it's actually a reported year in recurring revenue and non-recurring revenue in the kind of the silver bits at the top, and that shows that period on period that recurring revenue element is growing. The last 4 bars on that left-hand chart show the COVID impacted periods, and you can see that the non-recurring revenue, the silver bit at the top, has decreased compared to what it was in the first 2 bars. We would expect that really comes from our A&K business. A&K was particularly impacted by the COVID lockdowns, as it sells primarily to UK-based businesses, and they were closed and working from home during the lockdown, obviously. As we come out of lockdowns, we move into this coming year, we expect that the A&K revenues would return to pre-COVID levels, which you can see in those first 2 bars. The chart on the right-hand side just shows the growth in our annual recurring revenue. You can see that the element from Space Connect is increasing. That's the kind of orange part, but also consistently across the business, it's increasing from period on period. Just going into swipedon here, we had a large increase in the annual recurring revenue for swipedon, 57% year on year to 4.23 million. That is largely driven by an increase in the average revenue per user, the ARPU, which also increased by 58% year on year from £48 to £75 per user. What's really contributing to that is a number of things. First of all, it's a number of locations each of our customer has with swipedon. So we've been really targeting our existing customer base and looking for new customers who have more than one location, and that drives on that ARPU to a higher number. We also have in there the different price plans as well. So we have 3 price plans for swipedon. We have a starter, a business, and an enterprise. And as we encourage our customers to move up through those price plans, it increases the ARPU. We've released more functionality within our highest tiered price plan. And again, that helps us to attract more users to that plan as well. There was an increase in churn during the year, so it went from 6.8% to 10.9%. There's a couple of factors which are included in that. There is COVID, as we see businesses close down, and also as businesses work from home, and also to a certain extent, some companies who joined swipedon, in particular to manage their COVID-related risk. And as we exit the pandemic, a certain number of those left us. Looking onto swipedon desks, we launched that in the autumn of last year. We now have about 30 customers on swipedon desks, and we see that as a real opportunity to grow the ARPU within swipedon in the coming period. We have a number of positive potential opportunities we have for swipedon desks, which would really grow the ARPU for that business. The net revenue retention, which really shows whether we're growing from our existing customer base, was a healthy 130%. It's generally viewed that anything over 100% is positive, and we were quite considerably above that. As we move into next periods, we don't expect it to remain quite so high, but it will certainly remain above 100%, and hopefully above what we had in FY21, which was 105%. We recently launched into Korea with a fully local language variant of the swipedon platform. Frank will come on to that in a bit more detail in a second, but it is very much a cookie cutter plan for us to see how we can move into new geographies, non-English speaking geographies, and expand the customer base for swipedon.
So the South Korean launch, we actually went live a few weeks ago. The marketing campaign actually just kicked off a few days ago. The dominant search engine in Korea is actually Naver rather than Google, even though Google is present there, but it's very poor. It's a second search engine of choice in the market there, especially in B2B. When we talk about, we've got customers in 70 countries, but when we talk about this launch here, the product is fully localized. So the website, all of the blogs, the help files, the entire product, and then local language support. Most of our support takes place over chat. So we've got a native Korean speaker who will take the inbound inquiries and engage customers fully in Korean. Now, there's been a big preamble to this because we had to do a lot of work to the underlying platform, and the dev team were focused on that for the past year. Or actually even longer than that. We got slightly delayed and distracted because of COVID-related functionality which we introduced, but that's now complete. What it actually means for us is that we can, with the platform fully multi-region, multi-language enabled, we can churn out new languages really quickly. And I suppose if we were to strip it out, we're probably looking at about a month to 6 weeks to get a new language in there and get ready for launch in another country. More importantly, the cost of doing that is quite low. We've obviously been on the road for a few days, and one of the questions that's come up on the roadshow is how much have we spent so far on the South Korean launch, and it's worked out to be 25,000 New Zealand dollars, so about 12,000 pounds. So we're not looking at a lot of money when we talk about expanding out into other markets. We're talking about that quantum in terms of translation costs and a bit of staff costs. And then in terms of marketing spend, the agency we've appointed in Korea, their view was to allow a budget of no more than 20,000 New Zealand dollars a month, so about 10,000 pounds per month. And we want to give this a good 3 months now to see where it takes us and how many customers. None of the numbers we have in the market or even in our internal forecast have any revenues associated with Korea. So this very much now is about taking us outside our comfort zone of our traditional English-speaking markets with a view to opening up more sort of more key markets to us, rather than, we're in Korea already, but those customers are using standard English language product. Even though the Korean front end is translated, the back end is only in English. One of the questions, if I can preempt this, that I've seen on the screen earlier, that has been submitted, is which other markets. We've identified there's about 13 markets in the Far East, of which there's about 10 that we want to zero in on. We want to let Korea see it play out over the next few months, assuming that goes well. And it doesn't necessarily mean that Korea has to fly for us, but we just need to know that we've got the process right, as Chris referred to it earlier, as a cookie cutter approach. The next thing then would be what are the countries, and there's a whole range. It could be Taiwan, it could be Vietnam. We're going to avoid Japan for now. It's slightly more competitive. The dynamics in Korea, there's just a small number of local vendors. You'll see some of our main competitors advertise there, but they're on the back of global campaigns, but they don't have a fully localized and fully supported product in local language. So it's an exciting development for us, but we'll see over the next few months now how it starts to contribute to the overall performance of the business. In terms of Space Connect, as you know from earlier presentations, this business is focused exclusively on channel-based sales. We've been working hard with our partners over the last while. Where about 90-95% of this business is actually in the UK. We did expect that when the work from home mandates were lifted back in January, that there'd be a rapid return to the office. As we've all seen, it's been a slow upward curve rather than a sudden jump up. There has been a distinct uptick since Easter. So we expect now that that Space Connect will start to come through as we move into the second quarter, and then obviously into the second half. Softcat is still our main partner here in the UK, but we've also seen activity from other partners, and they're now starting to put deals on the board. People like XMA and CDW, who are all Insight, who are all significant partners of the same scale as Softcat. But then we've also developed our partners overseas. We don't plan to increase our partners beyond where we are now. What we are looking at doing is having a number of other bundling deals in place where we can actually sell Space Connect and exist in conjunction with other hardware. It's not along the lines of Evoco where it's white labeled, but where it's a bundled deal with a particular meeting room panel plus Space Connect, and you get a discount if you buy both. And we've been busy putting all of those programs together, so we expect those to feed through as well as we move into the next half year. Evoco, the big news there really is that they had the main trade show last week in ISC. It seems to have gone down really well. They had most of their distributors from around the globe came to see them. They presented a new pricing model, which we had agreed to earlier in the year with Evoco, where instead of actually charging hosting on a year-by-year basis, the customer now pays a bundled price for 5 years. The cash flow implications for us for that are actually very positive, because we're then getting 5 years money up front. So we think that would be good for us, but also makes it easier for the customer in terms of buying decisions. And they've also introduced a number of other campaigns. One of them is a discounted trade-in on existing panels. So there's a definite uptick in Evoco in terms of their shift away from where they are into focusing on NASO as this whole ecosystem. They've launched a new desk monitor, which actually won an award for the best technology new release at the ISE show, and that's called Clio. We don't get any money from the hardware side of that, but it's our software that sits underneath and drives it. So we make from the SaaS revenue as and when more of that gets deployed. So no stock issues with Evoco. They've actually physically got stock of NASO panels in Sweden. We're assuming this year we'll sell about 1,000 panels. They've got 19,000 panels in stock. Anything above 1,000 will help us keep ahead of our numbers. Their aspirations are still up in the well above 10,000 panels this year. So ultimately it's waiting for that to come true now, but definitely there's a sense that things are reopening for them, and people being back in the office are really important for the sales of meeting room panels. One question that we've been asked recently is skill shortage and what's it like recruiting and retaining people in today's market, and then also how we're coping with wage inflation. we were actually heavily committed to the Ukraine until the beginning of last year. All our Space Connect development was there. We were unnerved by a previous build-up of tension on the eastern border of Ukraine back in late 2020. That prompted us in early 2021 to make the decision to get out of the Ukraine. Our last person there actually left us in October. In the meantime, we then started to bring up the team down in New Zealand. Now, and for the last few months, they've been managing the entire Space Connect code base. And touch wood, that's been working really, really well. And that's for us, I think, has probably been an important shift. We've already centralized all of our technology under Matt Cooney, who's our CTO, sitting down in New Zealand. New Zealand itself, as you know, has always been a great market for us in terms of finding really well-motivated staff. The wage rates there are lower than we pay in the UK, but more importantly, the motivation and the skills of the guys are second to none, really, and we're very lucky to have the team that we have there. On the other hand, you know, West Coast US software businesses are actually coming into the market there and offering quite big salaries for people to work from home. Our response to that is to create a really good environment for the team down there. Yeah, decent bonus, social events, good staff development, the option to travel. So if someone previously, we weren't really in favor of the idea of one of our devs working remotely. We're now very much in favor. They're happy for them to come to Europe. The New Zealand borders reopened actually just 2 weeks ago. And I think that will actually help with recruitment in New Zealand. Because if you look at our workforce in New Zealand, there's obviously a lot of New Zealanders work for us, but we've had Brazilians, South Africans, Irish, British working with us as well. So I think as the borders open up, there will be an inflow of people into the market. We don't want to rely on that. And bearing in mind, we're already in favor of an offshoring model. We started to look for an offshoring partnership, and we've settled on Vietnam. We had looked at other markets, including the Philippines. The main reason for going to Vietnam was to find a partner where we could get the quality of skills, the volume of people, and at a price that made sense. And we cited some numbers there. So we're basically paying about a quarter on a like-for-like basis for what someone in New Zealand would have cost, and a fifth of what the same skills would have cost here in the UK. Our first team went live there in December. They delivered their first project in February. That went really well. We've now stood up a second team there, and it took a month for those guys to get mobilized, and they're busy working on things right now. And that's ultimately our strategic response to what is a global issue around IT tech skills and wage inflation. We have budgeted 10% increase for salaries, and we still believe that that's good enough for this year. And again, we heavily incentivize guys around bonus so they can go above and beyond. But we think we've actually got a good, robust response. And as we move forward in terms of development of our roadmap, the ability to bring more people on quickly without getting us into long-term agreements in Vietnam, as you can imagine, is highly attractive. ANK, it's our hardware distribution business. And the key with this business really is to get it back to its pre-COVID levels. And as Chris alluded to there, and that's already happening. It's had a good first quarter, and we've got a good pipeline of business for the next quarter. Even though it is a hardware business, the margins are higher than you'd expect. We operate 30 to 35% depending on the product mix that we sell. Now that people are getting more back into the office, we're seeing projects that were sold last year coming back on stream. So the main message really from ANK is that it's definitely coming back to that pre-COVID level. ANK is at that level is profitable and makes a contribution and actually doesn't consume any cash. So it's important to highlight that. And again, it's an exclusively UK business, so we're going to be sensitive to general sentiment here in the market. But at the moment, all very positive.
So just looking at the performance since the year end, so the business has continued to grow well. You see here that the ARR as of the 30th of April was 5.5 million, so that's up from 4.9 million at the end of the year, 11% you can see there. That's driven by increases in ARPU as well. You can see there that the ARPU for the group is up by 11%. Swipedon ARPU is up by 13% to 165 New Zealand dollars or £85. 85 pounds. 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 And the swipedon ARR has also continued to increase. So it's all the business there as the swipedon has grown very well. The Space Connect ARR is where it is at the beginning of the year, so it hasn't grown significantly for Space Connect. As Frank mentioned, things have changed a little bit for Space Connect. It's moved from being very much about COVID-related buying decisions to more business as usual, managing workspace requirements, and those decisions are taking a bit longer than they did under COVID, where it was an urgent requirement, and so that's why Space Connect hasn't grown as much in this period. The cash at the end of the 30th of April was 2.28 million. We obviously have forecasts going forward until the end of this financial year and beyond that as well, showing that we have sufficient cash under our plans that we have in place to grow the business and manage the costs we have in the business, and we have cash resources that we need. Those numbers that we presented here don't include the one-off element from Thermo Fisher. At the moment, that's a 5-month contract which we've signed. We hope and believe that might be renewed, but we're not including it until we're certain it will be renewed. So that's an extra 570 locations on top of the numbers which we've got quoted there, 7,471 for swipedon as of 30th of April. We do get a little bit of a benefit from the strengthening of the US dollar in the period. And so as you can see, that's moved from, I think it was about just over 1.3 at the pound to the US dollar at the beginning of the period to about 1.25 at the end of the period. And that gives us a bit of a benefit to the ARR numbers that we presented here. So on a more constant currency basis, that ARR numbers has increased from about 5.05 up to 5.5. So it's still a good increase based upon the growth within the business from the ARPU and from new customers.
In terms of where we go from here with the businesses, in terms of swipedon, clearly that move into the Far East. I mean, if you think right now, 95% of our business on a monthly basis comes from our 5 core markets, the US, Canada, UK, Australia, New Zealand. If we start to increase our footprint across the Far East, it would be great to see that getting to a point where we're bringing consistent business across 6, 8 or 10 markets. So that's underpinning our strategy. There's not as much international competition in those markets. And the general sentiment in those markets is actually a lot more positive than what we're wrestling with here, i.e. business is good, and we feel that we can capitalize on that. The key though is that we're not going to go and risk the business and spend hundreds of thousands or millions of pounds to break into those markets. We believe we found a good, effective way of doing it that's really scalable, and in due course, then we can start to look at how it's going to impact our numbers. But for now, we've just assumed we're not going to bring in any extra business and reflect that in revenue or ARR for now until we see what beat those markets can give us. Obviously, driving ARPU is a big thing for us. This push of customers up the swipedon price plans is really important. And we've done that by putting more of the complex functionality into the top end plan. So you could be a small business with single site requirements, but you want to do something complicated like integrate with Active Directory or Exchange. You can only get that in your enterprise plan, and companies are happy to pay. Now, even though we've put our prices up, we still got a significant price advantage over our competition. And we do have, our standard agreements with customers allow an RPI increase. So just because we've had one big price uplift now doesn't mean we're not going to do any in the future. Our view now, though, would be continue on this, on bringing through the rest of the customers on the price plan. We'll have customers that we spoke to last August who are on an annual plan, and we won't see the benefit of that flowing through into our revenues until this year. So there's going to be a bit of carryover from last year's plan as well. Obviously, the land and expand. I mean, that Thermo Fisher deal was quite significant for us because it's one thing commercially landing deals at that. The second thing then is actually getting them deployed. And in that case, we got the 570 locations deployed on swipedon in a matter of days. It was all hands to the pump when the guys in New Zealand were doing it. But actually, to know that we're capable of taking and digesting customers like that is really important. And we've cited other examples of customers in the past where we've got multi-location deals with, such as DHL and XPO and Gate Group and that. So we want to be doing more and more of those. And then obviously coming up with more things that we can sell back into our base. So you can see with time now, we'll see desks making a major contribution to that ARPU uplift. And obviously, and desks is showing a good momentum now. It was a bit of a step change in terms of how we sell. It's not as straightforward and fast as visitor, but it is actually, now that we've got our heads around that, or the guys in swipedon sales have, then it's each of the sales are sort of becoming that little bit easier to land and get deployed. The Space Connect is very much more of the same. As I said earlier, we don't plan to dramatically increase the number of partnerships. We are going to focus on a number of strategic partnerships. In the US, we've currently got 5 partners. Now we could carry on knocking on doors there and get up to 20 or 30 partners. It's actually quite an expensive and inefficient way of growing the channel. What we do want to do is jump into bed with some of our major hardware suppliers and other panel suppliers outside of Evoco, where we do a bundled deal as against the white label deal. And they in turn have distributors in market already. And we'll know from those distributors which ones are selling, and they're the ones where we want to put our energy. So there's a number of those initiatives underway behind the scenes, and we've been working on them over the last few months. And we brought out a mapping tool last year, and that's made a big difference to our business. It means we can provision customers really, really quickly. And it's also given us this very strong USP compared to our competition, whose mapping functions tend to be quite basic and don't have the functionality and ease of use. And clearly then making sure that NASO sales deliver through the remainder of this year and to next. And, you know, we're seeing a major push from them now. They had ISE last week. They've just announced a deal whereby you can trade in existing panels and you get a 20% discount on NASO. They launched the Clio desk module last week, or unit. So they're now really pushing a full ecosystem. So hopefully as we move through this year now, we see the confidence that we've had in NASO come to fruition. And A&K, that's very much business as usual. Even with us doing anything, there's actually a natural move back to that pre-COVID level, and it's been reflected in the first quarter sales and in A&K. In terms of markets and competitors, no major updates really since the beginning of when we reported last. I think it was back in February. I think we showed this grid then. Everything that's in black there are basically competitors who either been taken out or they've had major PE investment. I suppose the single biggest news is that valuations have come back since we spoke last. But there's still businesses, maybe not just in our area, but SaaS businesses where they're going for significant multiples that are significantly higher than what we're valued at today. But there's no doubt there's a lot of consolidation going on in the market, and as you can see from this grid, swipedon is a standout in terms of one of the better quality assets that's actually still not in the grips of someone larger. So I suppose the real message for today is we got off to a good start in the first half. It's our first quarter of this year, a good closeout on last year. Hopefully, as the world starts to return to normality, that we'll see this momentum continue. There's a definite shift in the narrative in the businesses that we're talking to. Last year, it's how do I make my workplace safe and enforce social distancing. This year is we are actually downsizing our real estate footprint, but we won't be serving notice on our leases until this quarter or next quarter. We still have 500 staff, but we'll only have 220 desks. This is an actual example from one of our customers. So just making sure we keep the pace of that, maintain our price competitiveness, and make sure that our products have got really good functionality. And then obviously that geographic expansion. And at the same time, then keeping a good eye on staff retention and the sort of remuneration of people, and having that versatile resource in Vietnam, I think will stand us in good state. So that was it really from us. So
Frank, Christian, thank you very much indeed for your presentation this afternoon. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated in the right-hand corner of your screen. But just while Frank and Christian take a few moments to review those questions submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Frank, Christian, as you can see, we've received a couple of pre-submitted questions as well as a number that have come throughout today's presentation. Firstly, may I thank all the investors for submitting their questions. And Frank, Christian, I will shortly invite you to open up that Q&A tab to respond to those questions where it's appropriate to do so. But perhaps for doing so, if I may start off the Q&A session with these pre-submitted questions. The first one reads as follows. After South Korea, what is the next non-English speaking country you hope to target? I know you've touched on this briefly in the presentation, but if there's any more colour on that, that'd be great.
Yeah, we've identified, we think, 10 key markets in the Far East. We haven't decided yet on the next markets. It could just as easily be Vietnam and Taiwan, or it could be Indonesia and Malaysia. We're very open-minded. We look at a number of criteria varying from local competition, the ability to find someone in that market. Yeah, as I've demonstrated earlier and discussed, the work involved in creating local language versions is actually quite quick for us. It would be good to stress test ourselves for the next one, and maybe next time, instead of going for one other country, we might go for 2 in parallel. Because ultimately, if we find we're getting traction in this strategy, we'd want to keep the momentum up. So, but we'll announce in due course as we decide when we decide which countries that we're going to go for, and we'll obviously, you'll see that on the swipedon website and that.
That's great. Thank you very much for that. And the next question that we have here reads as follows. It looks like H2 2022 was much slower in terms of new swiped on locations deployed than H1, with only 73 swiped on locations added versus 262 in H1. Could you briefly explain what drove this and whether we can expect to see more consistent sales performance this year?
Sorry.
Yeah, I can take this. Yeah, sorry. The nature of multi-location deals is that there will be a spikiness about them. I mean, one case in point now, for example, we've highlighted that we've excluded Thermo Fisher from our account. Now, if we were to add Thermo Fisher back in, we'd be adding 570 locations in on top of what we already did. So the nature of our multi-location deals, sometimes we'll end up doing 5 deals with 20 locations each. Other months it could be we might only do 4 deals, and of those, one is actually 100+ locations. So there will be a bit of spikiness as we move through. So I think maybe focus on the overall trend as against specific months or quarters. But the general push is upwards, and the big thing to watch with us really as a business is ARPU. You know, if we've, the beauty of going after existing customers, our cost of acquisition is really low. And if we've got more stuff to sell them and we can get account expansion, that's a really good use of our resources compared to always looking for brand new customers to sell into. What we have noticed with, for example, in the Far East, the cost of acquisition is a lot lower, and what you pay per click is much lower than what we pay in the US. So so that will feature as well in terms of how we go after customers. What's the most that we can bring in terms of additional ARPU for the amount of marketing dollars spent and the physical effort and that. But bear in mind there will be spikiness in it.
That's great. Christian, Frank, if I may just hand back to you to run through that Q&A tab and where it's appropriate to do so, if you could please just read out the questions and give your response, and then I'll pick up from you at the end. Thank you.
We have a bit of a technical issue here. Actually, we can't scroll down in that Q&A tab, so we can only see the pre-submitted question.
On the right-hand side of the screen, sir?
That's correct.
Yeah.
Would you like me to read out the questions for you, sir?
Now you've removed that top one, we can see the next 2 actually, so we can go through those.
Okay, perfect.
So given swipedon's multi-language form of success in Korea, which of the markets would you like to expand into, and how would look to land and expand there? I guess there's a number of different markets we can go to. There is other ones in Asia, but also in South America we'd look to go into. We probably wouldn't go straight into the other European markets because of the competitive situation there, but certainly South America and other areas in Asia as well.
And the next question is actually along a similar line. It's have you got another market that you want to target where English isn't the first language? I think we've probably answered that in the course of the previous questions. The next one is it possible to expand a bit on the partner network? How big it is it, and how it works? And are you looking to expand this internationally? Our main interest in partners is on the Space Connect side of the business. We've got 49 partners, and of those, probably 15 consistently deliver us business. Now, some of those take quite a while to get cranked up. You know, we've mentioned earlier, I think people like XMA and CDW, we've been engaged with them for a year, and it's only now they're putting some deals on the board. But now that they're on there, there'll be a momentum to those. At the heart of our approach really is to get the ones we have working. With Channel, it has the potential to soak up a lot of resource and money and actually not deliver anything. So making the ones we have work, winnowing out ones that maybe aren't working from the group that we have, and we don't believe we have many of those right now, is probably the best use of our resources. And then piggybacking on the back of these other relationships with the hardware vendors we alluded to earlier. So by the end of this year, we haven't budgeted to have many more partners than we have now, but if we found on the back of a joint promotion with a hardware vendor in the US, we found another 10, and those 10 were ones that are capable of giving us good business, then we definitely get rowing behind those. As we haven't mentioned ESCO, who are a partner in the Far East, where we're engaged with them now in multiple geographies. We've got deals on the go in the Philippines, as we had previously, but now also Singapore and India and some of their other geographies. And again, focusing on servicing them well rather than going wide, I think is a better use of our resources. But I think sort of staying around the same level, if we did find that we needed to increase, then we you know, it's an incremental headcount increase. One other account manager could probably manage another 5 or 10 partners. So we're not talking about doubling our sales force or anything.
Next question, how quickly are office owners recognizing the benefit of adapting to hybrid working? We think that's happening very quickly. Actually, we can see in our pipeline that there's quite a good number of potential customers who are saying that they're looking to take us on, but it might not be until June or July, until August, but we can see that they're approaching and that there's good opportunities there. So I think it's good for us.
Yeah. The next one is, has the consolidation in the sector left you facing stronger, better funded competitors? Is there a risk of you being left at the altar as the industry consolidates? If you think that the biggest competitor in the market is Envoy, they've just had a big investment in from Brookfield. Now Envoy, whilst they sell globally, their main markets are the US and then a small bit in the UK, a small bit in Australia. So whilst they're well funded, we're not convinced that they use their money as we're forced to do as a much smaller business. And what we're looking for is to find areas where we're not butting up against them. We actually win quite a bit of business against Envoy, and then once we keep the innovation in our technical roadmap, I think that gives us an element of defence. They'll always outspend us, but you know, for example, on Captera, where you actually pay to get the top of the list, we tend not to go for number one, where you're paying a huge amount of money just to get each click. But we still find that we get as much business if we're number 2 or 3, but it costs us maybe 1/3 of maybe what someone like Envoy is spending. So a lot of their work is actually going in a lot of their money is actually going in marketing, and you know, and I think we're probably making better use of our marketing dollars, and I think you know, and in terms of size, I mean, they boast about 10,000 customers. We got 4,700, so it's not like they're 20 times our size. And the overarching thing is we're actually in a very, very immature market. There isn't any competitor who has actually got 200,000 companies using their stuff. So it's not like that you know, we're running out of road. And I believe if we take the battle away from the core markets, where it's quite expensive to acquire customers, and take it to new markets, we'll end up with a business that strategically is in a much stronger position and of much higher value.
Next question, aside from wage increases, why have admin expenses risen so much, 35%, which is much higher rate than revenues? I guess there's a few things which are in there. There's things like amortization in there, which is a one-off thing, which as we acquired Space Connect, we now have a full charge of that in this year. There's things like share-based payments, which are very much technical, but don't relate to cash whatsoever. And again, it's related to the particular share price at the time that we issue share options, and so it doesn't. We don't really concentrate too much on that ourselves in terms of that value. And I guess the main thing is the wage, the cost of salaries within the business, and it's not necessarily an increase in what we've paid to everybody. It's the fact that we started the year with a relatively small team within Space Connect, and we finished the year with a full team there. We also had a little bit of inflation within the marketing costs. And it wasn't too huge, and we certainly managed that very carefully. But it did increase a little bit on the prior year.
And more importantly, is that we see that admin expenses line sort of flattening out now. It won't continue growing, and where we are going to make additional investments, it's an incremental hit here and there. So it's not we've topped out now at where we are, and whilst we take on more people next year, it's incremental as against a fundamental shift in the cost base.
And I think the final question here: what overdraft facilities do you have, and when do they expire? We don't have specific overdraft facilities, but we have the ability to access funds through our banks in New Zealand. Which we haven't drawn on, and there's no particular deadline for us to do that or anything like that. There's no cost for us to have that facility there. It's just something which is available to us if we decided to go ahead.
I think that was all the questions.
Absolutely, Frank, Christian, thank you very much indeed for being so generous with your time there and addressing all of the questions that came through from investors this afternoon. Frank, Christian, perhaps for redirecting investors to provide you with their thoughts, their expectations, their feedback, if I could please ask you for a few closing comments to wrap up with, that would be great.
Great. Well, I think the real message really is that despite what's going on in the broader market, I think the market for our products is there and actually will grow as premises consolidate. And we continue to want to be one of the leaders in space optimization. If you've got a business where you're reducing office space and without reducing headcount, you can try and manage it on a spreadsheet, but very quickly it becomes unmanageable, and that's the gap that we fill. And we believe that our geographic spread gives us a very strong business. So yeah, absolutely, from our side, we're just heads down and tails up and driving on with the strategy that we've outlined during the presentation. And thank you very much for your time today on this call.
Thank you, brother.
That's great. Thank you very much for that. Frank, Christian, Lisa, thank you very much indeed for taking the time to update investors this afternoon. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure would be greatly valued by the company. On behalf of the management team of SmartSpace Software PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.